It is, of course, a very challenging situation. We're facing a very big shock to inflation. And unfortunately, in the last 3 months since we last did a forecast in the monetary policy report, that challenge has got much bigger. It's coming from predominantly and overwhelmingly from one source, which is energy pricing, and particularly gas prices, and I'm afraid it is coming from the actions of Russia. Now, our concern is that, of course, we have to bring inflation back down to target from a very high level. Now, other things equal, we think it will come down. The question for us is, are other things going to be equal? And really is about the question of, is inflation going to be persistent and become embedded? Now, we do see risks on that front, and that's why we've acted. And the risks are, and this is where there is a domestic element to the story. We've had a shrinkage in the domestic labour force over the last 2 years or so, during the COVID period. And so when I go around the country talking to firms, as I do a lot, they are still saying to me two things, really. One, we're struggling to hire people. Two, actually we can increase prices. We're not hitting resistance on increasing prices. Now, we understand, obviously, the situation, but it concerns us because that's one way in which inflation can become more embedded. And then we would have to raise interest rates by more than otherwise. So our action today was very clearly, we feel we've got to take stronger action, as we said we would, because we changed the language of our sort of, in a sense, forward view back in June to say that if we saw this evidence of persistence, we'd act forcefully, and that's what we've done.
Right, and wage pressures certainly are building. Pay growth is averaging anything between 5% and 6%, depending on how you're looking at it. Do you think the wage pressures would be less pronounced if the Bank of England had tightened faster and sooner than what you've delivered already?
Well, I think it's important to bear in mind the shocks that we've been subjected to, and in a sense the point at which we can understand what these shocks are, because they're coming from outside. So we don't make policy with hindsight. I will say to people, I think when we were sitting here as we were a year ago, I think if we'd said there's going to be a war in Ukraine, we'd have said, really? That is not things that frankly were foreseen, and I think could be foreseen. So I think the debate around, well, if you didn't raise interest rates sooner, wouldn't it have been different? Frankly, is made really by people who think that policy making is done with hindsight, and I'm afraid it isn't.
Well, it is tricky. Turning to the short-term interest rate curve, the market assumes that you will go for, let's say, another 150 basis points worth of hikes over the course of this hiking cycle, but then start cutting interest rates. What do you make of the argument that the Bank of England have to hike now in this small window before the economy starts turning south?
Well, we take our decisions based on the evidence that we see now. So, it's not a sort of case of us sitting down saying, gosh, if we don't do it now, we're not going to be able to do it in the future. I mean, our decisions are entirely based on what we see today. Now, you're right about the profile of the market. Now, look, we do not endorse the market curve. We use the market curve as a conditioning tool for our forecast, but it doesn't mean to say we endorse it. So I'm not going to give a commentary on where we think policy is going to go relative to where the market thinks it's going to go. I think it's interesting, as you say, that the market, and it's not just, of course, our curve, actually, you can see it in other curves as well, other countries, thinks that we're sort of going to go up and come down again. And again, without wishing to endorse in any sense, I think the rationale, behind the market thinking that is they think you're going to have to act more aggressively early on, but you may actually have to go above what would be the sort of the equilibrium level, if you like, and then come down again to sort of get inflation out of the system. And I can understand why the market thinks that could be the way we go. I'm not endorsing that, but I can understand why. I mean, it's interesting if you go back in time, because I think people would have said, well, that's a policy mistake, and I think the rationale and the thinking in the market now is not so much it's a mistake, but actually it's a path that would deal with expectations, get expectations under control, and then you can bring rates down. Now, we're not endorsing that path, but I think it's an interesting way in which the market has evolved.
And just a question on financial conditions. I noticed today you obviously hiked by 50 basis points, and yet the pound is about 0.5 percentage point weaker. So from that perspective, the interest rate hike hasn't really transmitted through, quote unquote. Does that worry you? Because obviously a cheaper pound means more inflationary pressure.
Well, I think you always have to judge the weight of the short run reactions in markets against what people were expecting. I mean, market reactions are always against what they were expecting. I think you also should, I always feel it's interesting to look at how they react in what is it, the 2 or 3 hours. But actually, let's see where it is next week and thereafter. So, yes, of course, I follow it closely, but I think we have to be a bit careful about over-interpreting very short-run movements.